So one way that we think about the value of financial projection is a little bit glib, but kind of fun. It's the 1-10-100 rule. So that rule goes that $1 spent on prevention will save you $10 spent on correction. It'll save you $100 based on a failure. That's what you want with financial projections and business planning. You want to reduce your risk once you hit the real world. So for financial projections, we've broken it down into 7 steps. So the first step is who is going to create the financial projections. Your choices are somebody internally, a consultant, or sometimes an organization has an outside financial firm. Any of them are fine, but you need to make sure they have the skill set to do what can be sometimes kind of complex financial projections. So number 2, you want to identify your overall assumptions. All that means is that financially, are you going to pay for this new thing by earned revenue, by philanthropy, new contributions? How are you going to pay for it? Or how do you think you're going to pay for it? You need to identify your assumption, then you can test it. The way to test assumptions, there's a couple ways. One is to look at past performance. That's always helpful. Have you run a similar program? Did people pay for it? How much did they pay? How many people came? And then a second way is to look at the market. Are other people charging? Are other philanthropists paying for this? So that's how you might test your underlying assumptions. So number 3 is that you really need to zoom in on the detail of the specific drivers, what's really going to cost. So how many participants, how much will they pay? Also on the revenue side, are you going to pay for it through philanthropy? Or are you going to pay for it through earned revenue? Number 4, it's just the companion to number 3. Step number 4 is test those assumptions. An example of testing those assumptions would be to look at past performance. Have people paid for this before? It would be to look at your philanthropic track record, or to look at how other people have paid for these kinds of things. Number 5 is creating financial statements. All that really means is taking those assumptions and that information you've been testing, putting it onto paper in a financial format. Number 6 is to quantify how much capital you need to launch. So in the nonprofit world, nobody talks about the importance of capital. In fact, it's critical if you're going to do something new, if you're going to do something bigger. You need to know not only what it's going to cost you to operate something over time, but you need to know how much is it going to cost us to start this work. So capital expenses, they might include things like operating without any revenue for a period of time. They might include a consultant for the first year who's helping you to design and test things. It might include an evaluation process. It might include a new building. Those are the kinds of things that costs that you have at the beginning that you don't necessarily have on a long-term basis. So the final step in creating financial projections is to think about your audience. Who did we prepare this for? Just an example, if you prepared your business plan and your projections primarily for a funder who you know is interested in your endeavor, then think about what they want to see and make sure you've accounted for it. So for example, a lot of funders, they want to know that somebody else will also be contributing. So make sure you emphasize that. Sometimes though, the financial projections, they're a management tool for internals. So then you really want to think about financial milestones so that management knows they're on track or not on track. Thinking about your audience is just about it's not about different information, it's about thinking about what information you emphasize or might expand on a little bit further. So there's really good reasons for pursuing financial projections and understanding them as part of a business planning process. What you've done by digging into your financial projections is that you are actually making sure that you're telling yourself the truth. And by doing that, you're grounded in reality so that when you hit the road and you start your expansion, you are so likely to succeed because you've thought it through and you've prepared for what's going to come.